Japan's population is literally shrinking. They've had many rounds of different stimulus initiatives that has been a problem for public finances, right? So we've had structural deficits in Japan. We've had a big buildup in government debt. And then we've had this just extraordinary situation, right? That the monetary authorities, the Bank of Japan, has been delivering very low interest rates, but also doing quantitative easing, buying an enormous amount of these government bonds. So we have a situation where the government has issued all this debt, but now, because of the monetary policy experiment under Kuroda, the Bank of Japan has bought, like, call it roughly half of all that debt, right? And injected that money into the system. And linked to that, we saw the Japanese currency come under very significant pressure starting in the first half of 2022. Like when I joined Nomura Securities in around 2009, like you referenced, right? We had a long period where essentially dollar yen was gravitating towards 80. We got to 150 in the autumn of 2022, from 80 to 150. Now we're talking about pretty big moves here, right? And this is not, a hyperinflation country or something like that, or like Turkey or Venezuela, where you understand the currency needs to go down because it needs to compensate for inflation. Japan still has low inflation, so having such an extraordinary move in the currency, even though you have lower inflation than your trading partner, is quite something, and obviously linked to a monetary policy situation that has been diverging up until December from everything else that's going on in the world in a way that is pretty much unprecedented. So just a fascinating situation to analyze. And I can tell you, out of the Exante data client base, we've had a lot of people spending a lot of time in Tokyo over the last couple of months. A lot of people are really doing their research now in Japan, right? Yeah. Because the moves have been historical, very big. And if it is the case that we're finally going to have a normalization of policy after essentially authorities maxing out how easy they can be for such a long time, if they're going to start to go in the other direction, it's going to be epic. And we saw kind of a prelude to that in December, right? When they just tweaked essentially where the levels they control the bond yields within, allowed them to move from previously max 0.25 to now 0.5. Yeah. And that create shock waves in global markets. That's a little bit of a prelude to, okay, if they've really let the bond yields go, if they actually had to hike interest rates, we could get enormous moves out of Japan. So I can understand why people are spending time in Tokyo.
Yeah, absolutely.
Beyond the good sushi.
Yeah, exactly. Okay, got it. Well, there's quite a few things I want to return to, but perhaps, I guess, to further set the scene, I was reading about their security concerns, some of which are pretty obvious. You've got China, North Korea, and Russia that are potentially exacerbating the macro problems that the country is facing. You talked about the debt burden. I think it's the highest in the industrialized world, more than double its $5 trillion economy. So to what extent do you think those security concerns exacerbate the problem?
Well, so I think this is this is a topic that goes beyond Japan. This is something that I think for investors that are thinking about asset allocation and trading in 2023 is one of the most important issues, right? Because you're going to have different countries with different debt levels, different leverage, and different sensitivity to moving interest rates around. And you can certainly have the concern that, okay, Japan might have inflation go from 1% to 3%. And maybe they will normalize their interest rates from, they're slightly negative, like they're minus 0.1 now. Maybe they will go from minus 0.1 to, say, plus 1. But that will be a small move relative to inflation. If inflation has moved from 1 to 3, then moving interest rates by 1 percentage point, or slightly more than that, is not really a lot. So if you go and calculate, debt dynamics, like if you look up the equation that you had in university, like it has to do with the growth rate of the economy and the interest rates and how these two are in relation to each other, right? So the real problem for debt dynamics come when the interest rate moves more than the normal growth in the economy, right? So the question you can have is, if inflation starts to move, are they really willing to move that normal interest rate sufficiently to generate any increase in real interest rates? And that's a concern you can have with Japan. It's also a concern you can have with many other G10 economies, as we call them in currency markets, right? And it's really interesting that if you look at what's going on in the currency market this year, a lot of the economies that have the highest debt levels, and Japan is a bit special because they now have this shock around monetary policy, but if we just look broadly, like places like Canada, where they have a housing market with a lot of leverage, the United Kingdom, where we have a housing market that's also in trouble and leveraged consumers, those are actually some of the markets that have done the worst, some of the currencies that have done the worst. Whereas in the past, when we had debt cycles, it was often like, and people are worried about emerging markets. There's some emerging markets that have almost no debt. Like the economy operates almost the same, whether interest rates are 5%, or 7%, 9%, doesn't really make much of a difference. The only difference that matters is to the currency and how foreigners think about trading that currency. Mexico is a bit like that. I'm exaggerating, but like private sector, like consumer debt to GDP is like something around like 20% of GDP, is like nothing compared to G10 economies. So when we think about how the world is responding to a situation where we go from zero interest rates to something that is far from zero now, call it 4, 5, 6% in many G10 economies, those transmissions are going to be totally different. And that's going to differentiate how the currencies are performing.
Great. So going back to then last Monday, when the Bank of Japan maintained the policy balance rate with minus 0.1%, when a lot of investors had been expecting a change. Firstly, did that decision surprise you at all?
Well, so I've been watching Kuroda since he was appointed in 2013. He's a pretty stubborn guy. So really, the surprise was that there was some movement in December, right? That there was some step towards normalizing policy. I think it's much more logical to say, okay, there's a new governor of the Bank of Japan coming in April. That new governor will have to set the tone for a multi-year period, whether that includes, normalizing what's going on in the bond market, allowing bond yields to move, whether it involves, moving actual central bank interest rates. So that's a situation where we're looking at. So I don't think it was a massive surprise that Kuroda didn't want to embark on some dramatic monetary policy shift right before he's on his way out. The big question now in Japan is the inflation we've had. Like, how sticky is it? Is it just, commodities moving around, that type of thing? Is it just a temporary reopening of the economy? And we're going to have a very interesting situation because now we have China reopening, which is going to have some spillover effects, certainly to Japanese tourism and so forth. And then we have a situation where the Japanese labor market is kind of recovering from the COVID shock with a lag. And there's an incredible focus on wage growth, right? The main indicator the Bank of Japan looks at to sort of gauge, okay, is the inflation pressure more sticky, is whether wages are moving as well. So they have a specific mechanism for negotiating wages for big enterprises. We'll know results of those negotiations around Q2. So a lot of people think really Q2, and I agree with that, is when the new governor is going to look at the data and make a decision. Okay, what's the new framework for the Bank of Japan? Is it going to be a big shift from what Kuroda had? And I think if you look at where the yield curve is in Japan, we've actually had some movement back and forth. But from where we are now, after the retracement down in yields across the curve, we're not pricing much prospect of a meaningful normalization of policy, right? So if inflation does prove sticky over the next 6 to 9 months, there could still be a big shock to come.